What if I told you that right now, at this very moment, silver is being traded at two completely different prices on two sides of the planet, and the gap between those two prices has become so wide, so unusual, so historically significant, that the last time we saw anything close to this, silver didn't just go up, it exploded. And the people who understood what that gap actually meant walked away with life-changing gains, while the rest of the world sat there watching the news, completely clueless. Now, before you think this is just another silver to the moon video, I want you to stay with me, because what I'm about to show you is not a theory. It's a measurable, trackable, real-world signal that professional traders watch very closely. And most everyday investors have never even heard of it. So give me the next 10 minutes, because by the end of this video, you're going to see silver in a completely different way. And you're going to understand exactly why the Shanghai versus US price spread might be the most important thing happening in the precious metals market right now. Let me set the stage for you. There are two major exchanges where silver is actively priced and traded every single day. One is in the United States, specifically the COMEX, which is part of the CME group in New York. The other is the Shanghai Futures Exchange, or SHFE, in China. Now, in a perfectly balanced global market, these two prices should be very close to each other after you account for currency, shipping, and standard arbitrage adjustments. That's just economics 101. If silver is cheap in one place and expensive in another, traders will buy it cheap, ship it over, and sell it for a profit until the prices equalize. That's the theory. But here's where it gets fascinating. Because right now, that equalization is not happening the way it should. The spread between Shanghai and the US has been widening. And the reason it's not being arbitraged away instantly tells you something incredibly important about the physical demand for real, tangible silver in the world's largest manufacturing economy. Before we go any deeper, if you're learning something new right now and you want more content that breaks down real market signals, like this one, go ahead and hit that like button and subscribe to this channel. I put out content that most financial channels don't touch because they're too busy covering what already happened. Here we focus on what's developing right now before it becomes headline news. So let's break down exactly how this spread works and why it matters. When silver trades at a premium on the Shanghai Futures Exchange compared to COMEX in New York, it means buyers in China are willing to pay more for silver than buyers in the United States. Think about that for a second. China is the world's largest consumer of industrial silver. They use it in solar panels, electronics, electric vehicles, semiconductors, batteries, and hundreds of other manufacturing applications. So when Chinese buyers are willing to pay a meaningful premium over the global benchmark price, they are sending you a direct, real-world signal about the tightness of physical supply relative to demand. They need the metal. They need it badly enough to pay up for it. And right now, that premium is not a small rounding error. It's substantial. It's the kind of spread that makes institutional traders take notice. Now, here's where history becomes really powerful. Let me take you back to a period that most people have conveniently forgotten about. In late 2023, going into 2024, we saw a similar divergence begin to build between Eastern and Western silver prices. At that point, many mainstream analysts dismissed it. They said it was a technical anomaly. They said it would normalize quickly. Then silver went from around $22 an ounce to nearly $33 in just a matter of months, a move of nearly 50%. The people who understood the Shanghai spread saw it coming. The people who didn't were left scrambling to buy silver at prices they had been mocking just weeks before. And here we are again. Except this time, the backdrop is even more compelling. Because now you have several additional forces converging simultaneously, and when multiple tailwinds line up behind the same asset at the same time, that is when the biggest moves happen. Let's talk about what those forces are. First, you have the solar energy build-out. This isn't a future story anymore. It's happening right now at a scale that most people genuinely do not appreciate. Silver is absolutely irreplaceable in photovoltaic solar cells. There's no viable substitute that maintains the same level of efficiency. And the world is building solar infrastructure at a pace that is outrunning silver supply. The Silver Institute, which is not a bulls organization, it's an industry research body, has reported consecutive years of structural supply deficits. That means demand is greater than mine supply every single year. Those deficits have to be filled from somewhere, and they're being filled from above-ground stockpiles. Those stockpiles are not infinite. Second, you have the geopolitical dimension. We're living through a very real fragmentation of global trade. Supply chains that used to flow freely between East and West are being restructured, rerouted, and in some cases, completely severed. When that happens, pricing dislocations become deeper and they last longer, because the arbitrage mechanism that normally closes price gaps has been disrupted. That's not speculation. You're literally watching it happen with the Shanghai versus US spread right now. The metal isn't flowing as freely as it used to, and that's keeping the premium elevated. Third, there's the currency element. The US dollar has faced serious questions about its long-term value as governments around the world continue deficit spending at historic levels. Silver, like gold, is a real asset. It has no counterparty risk. You can't print more of it overnight. When confidence in paper money starts to erode, even slowly, even quietly, real assets tend to reassert themselves. Silver has historically been the more volatile of the two precious metals, which means it tends to lag gold in the early stages of a precious metals bull market, but then dramatically outperform in the later stages. And if you look at the gold to silver ratio right now, silver still looks historically undervalued relative to gold. That ratio has historically normalized at levels that would imply a silver price well above where we are today. Now let me address the big question directly. Can silver reach $100? Let's be honest and analytical about this rather than just throwing out a number to get clicks. $100 silver would represent a multiple of its current price. That's an enormous move. Is it possible? Yes. Is it guaranteed? Absolutely not. Nothing in markets is guaranteed. But here's what I will say. The conditions that would need to exist for silver to make that kind of a move are either already in place or actively developing. Persistent supply deficits, explosive industrial demand from green energy, geopolitical supply chain fragmentation, a weakening dollar narrative, and now this Shanghai spread that signals tight physical supply in the world's biggest consuming nation. Each of those alone would be a positive catalyst. All of them together, compounding at the same time, while silver remains arguably one of the most undervalued commodities on the planet. That is the kind of setup that produces historic moves in markets. Whether it takes 1 year or 5 years to fully materialize doesn't change the nature of the opportunity. What's remarkable is how underowned silver actually is compared to other assets. When you look at the total above-ground investment silver inventory relative to the amount of money-chasing assets in today's financial system, the numbers are almost incomprehensibly small. You could fit the entire annual global silver investment market inside the daily trading volume of some major US tech stocks. If even a fraction of the capital that floods into conventional assets were to redirect towards silver, the supply simply isn't there to absorb it at current prices. The math on that is not complicated. So what does a smart, informed investor do with this information? Not financial advice. Always consult a licensed professional for your specific situation, but the general principle is straightforward. When you identify an asset with a measurable real-world demand signal, a historical track record of dramatic moves when that signal fires, a structural supply deficit, and a price that still looks undervalued, relative to historical norms, you pay attention. You do your own research. You size your position according to your own risk tolerance and financial situation. You don't bet the farm on any single asset. But you also don't ignore a signal this clear when it's flashing right in front of you. The Shanghai versus US spread is not background noise. It's one of the most honest signals the silver market produces, because it reflects real buyers paying real money for real metal in the real economy. And right now, that signal is telling you something important. Now I want to hear from you. Do you think silver is heading toward $100, or do you think this is just another precious metals hype cycle? Drop your honest opinion in the comments below. I read every single one, and I genuinely want to know where you're coming from. And if you found this breakdown valuable, please share it with someone in your life who's been watching the silver market or thinking about getting into commodities. Most people in your circle have never heard of the Shanghai spread, and sharing this video might be the most useful financial insight you give them all year. This is John AG 1.0. Stay sharp, stay informed, and I'll see you in the next one.